Good day. I will be walking you through the financial feasibility analysis conducted by myself, considering three investment opportunities and evaluate each to differentiate the optimal investment opportunity that is the most feasible out of all considered. To evaluate such investments, it will be necessary to work towards realizing the net present value of each option, thereafter comparing each to 1. Evaluate that the option of interest is indeed financially feasible, and if so, 2. Which option yields the highest cumulative net present value. A period of 5 years will be used to conduct the analysis of the various options. Swiftly moving on to the financial feasibility overview worksheet, we will first focus on option 1. Namely, on to rent out the unfurnished apartment on a year-to-year basis using the services of a rental agent. All upfront costs required were refinanced into the bond immediately, yielding a new loan value at the start of the study period as seen in the bond repayment worksheet. Both the adjusted bond value and upfront expenses were accounted for on the face of option 1's NPV table as seen here. It was then necessary to account for the annual rental incomes and expenses representative of option 1. When calculating the annual rental income for the projected period, it was therefore necessary to evaluate the historical data provided to realize an average percentage increase in the annual rental amounts of previous years of 4.78%. For conservative purposes, it was assumed that the increase in rental amount would remain constant at this average, which could create sensitivity in the rental amounts realized if understated. However, considering the current property market of South Africa, a slight underestimation would work in our favor, mitigating as much risk that is present in the South African economy today as possible when it comes to rental property valuations. Once realized, the values were extended into a detailed breakdown of each monthly rental income to match the specific period under study, as can be seen over here, enabling annual rent incomes to be forecasted and thereafter translated to the face of the NPV table of option 1, as can be seen there. For simplification purposes, a checkbox was used to incorporate the cost of laminated flooring into the initial refinancing and observe the corresponding net present value change as a result. As can be seen here, the values are adjusted accordingly. When accounting for expenses, inflation had to be considered, hence resulting in the inflation rates for the study period to be forecasted as seen in the inflation worksheet, as can be seen over here. For the years 2019 to 2020, the projected inflation rates were obtained from a reliable source which incorporated numerous external factors that would affect it. Thus, year 2023 was forecasted as shown over here. Once these values were realized, they were translated into the annual expenses worksheet and used accordingly. Property appreciation was also calculated and translated to the annual expenses worksheet to calculate the projected annual maintenance costs of such an investment, as can be seen here. It was found on this web page that it is a good estimate to go by of 1% of the initial value of the property. However, to create a safety net, the maintenance cost was calculated in correlation to the property appreciation value during that period, which can be seen over here. To forecast rates and taxes and levies, a CPI calculation was carried out for each as seen on the screen. As can be seen here, there's the CPI calculations for each. An annual agent fee of 8% was assumed for the rental agent and was calculated by incorporating it with the annual gross rental income for each period. Annual expenses were then summarized and translated to the face of the NPV table of option 1. Bond repayments and annual interest incurred was also translated from the bond repayment table as seen earlier. Bond repayment, to accurately calculate the corresponding tax of the taxable income, the personal taxation tables were forecasted, as can be seen over here, taking into account for an increase of 4% per annum. The applicable tax bracket was thus highlighted and translated to the financial feasibility overview worksheet. To calculate the tax value for each period, after-tax cash flows and net present values were calculated and accumulated to realize a final net present value of 2,118,571. This is inclusive of the net profit of the sale of the property at year 5 after deductibles as calculated in the project cash flow worksheet, the end of project cash flow worksheet, which can be seen over here. With laminated flooring as an add-on, a net present value of 2,128,507 Rand and 51 cents was therefore realized. Moving on to option 2, which involves renting out the furnished apartment on a short-term basis through either Airbnb or Lekker Slaap. Both platforms were considered, as can be seen in the rental income historical data table. And Airbnb proved to have the better commission rates, hence was used moving forward with the analysis of this option. By visiting the Airbnb website, which can be seen over here, a monthly earning potential of 10,001 Rand was realized for 2018. Rental amounts for the remaining period were forecasted by taking inflation into account and thus segmented to determine the annual rental income amounts for each period, as can be seen over here. These values were then translated to the face of the NPV table of option 2. The upfront cost for option 2 incorporated for the furnishing of the apartment to the value of 50,000 Rand and thus translated onto the NPV table, which can be seen over here. The adjusted loan was calculated according to the refinancing of the upfront expenses, which can be seen in your bond repayment table under option 2, and then thus was therefore translated onto the face of your NPV table for option 2. Once again, all relevant interests occurred and loan repayments were translated from the bond repayment worksheet for option 2 onto the NPV table. Option 2 realized a cumulative net present value of 2,243,238 Rand and 71 cents. Option 3 involved selling the property and investing the capital into a portfolio spread across no more than 3 unit trusts with the assistance of a financial advisor. To determine which unit trust would be best, a table of the top 10 single performing unit trusts were drawn up and it was decided to invest all of the capital into the single unit trust to maximum earning potential in a relatively safe environment considering the size of its asset portfolio, which is the Allan Gray Balanced Fund. The trust information was obtained from the trust-specific online brochure on the Allan Gray website, which can be seen over here. Corresponding performance incomes and fees were calculated in partial fulfillment of realizing such incomes and expenses for option 3's net present value table. The plumbing cost of 10,000 Rand was unavoidable, and hence a comparison was done between a personal loan and credit card debt, with the personal loan, as can be seen over here, with the personal loan yielding a lower total amount paid inclusive of interest. All values related to option 3's analysis were carried through to the face of the NPV table, which was thus yielded a cumulative net present value of 1,830,840 and 91 cents. Taking all results into consideration, the analysis validated that every option is indeed financially feasible. The most prosperous investment opportunity would be the short-term rental route with Airbnb, since this option had the highest cumulative net present value. Considering the property market here, South Africa today, a lot of volatility is present due to the economic constraints that the country is currently facing. Hence, due to a shortage in funds, I see this increasing the demand for average value rentals in South Africa. However, talks of land expropriation and currency downgrades could create uncertainty, forcing the banks to withhold bond allowances as much as possible. The model is indeed sensitive to many values, including inflation and assumptions on steady economic growth over a 5-year period. However, I do feel investing in option 2 is the way to go. Thank you very much.